Well, markets have hit new record highs this year, but with concerns about growth and whether the AI trade has become overextended, will the run continue in 2026? Well, our featured guest today says there are three themes investors need to stay focused on. Joining us now for more is Jing Roy, Vice President, Director, and Portfolio Manager for Asset Allocation with TD Asset Management. And Jing, welcome to the show.
Thanks for having me.
Great to have you here. Okay, so let's talk about the outlook for 2026. Explain to us why you still remain bullish on risk assets.
The stock market has had very strong run in the past 3 years. And going into 2026, we think that the constructive backdrop will continue, and that will be good for risk assets and stocks. So that's really indexed to three themes. First of all is the growth, resilient economic growth in the US. And second is a strong fiscal stimulus. And third is really tame inflation. So I'll unpack those three themes. Number one, U.S. growth is pretty resilient right now, especially going to first half of 2026, because we'll be lapsing the Liberation Day tariff headwinds. At the same time, the tax refunds from the One Big Beautiful Bill will start to flow through to corporations and consumers to support spending. And on top of that, the rate cuts that the Fed has implemented so far will start to flow through the system. So all things taken together that will support the U.S. economic growth. And on top of that, we still have the AI spending that's contributing positively to GDP growth. The GDP growth and the strong fiscal impulse will ultimately translate to very healthy corporate profits. So for 2026, for the S&P 500 index, we're seeing earnings growth ticking up to about 13.5%. And in Canada, the growth will taking up to 16%, and that's very healthy growth rate. And if the AI trade can actually supercharge the productivity growth, allowing companies to do more with less, then we can see more equity share price upside. And taking that together, we can see equity price or equity return in the low to mid-teens range, and that's pretty positive. And then lastly, if you look at inflation, it's inching towards Fed's 2% target, and it's very well behaved at the moment. That really relieves the tension between Fed's dual mandate and allow Fed to cut interest rate to support any labor market weakness. So taken together, I think the resilient economy, the fiscal stimulus, and the tame inflation will provide a very constructive backdrop for equity in 2026.
Okay, so given that backdrop in 2026, you also have three big market themes that investors need to be focused on. We'll start with the pace of AI monetization. What are you seeing there?
AI is becoming a very important part of the U.S. economy and the stock price returns. To give you a sense, in the first half of 2025, U.S. GDP growth would have stalled without AI contribution. As a result of that, earnings from the S&P 500 index, 40% of earnings growth come from AI beneficiaries. So the pace of AI monetization really will have a large impact on stock returns because that goes hand in hand with the efficiency gain and productivity gain AI adopters are experiencing, and that means higher margins and profitabilities for AI users and builders. And ultimately, that is a virtuous cycle for AI, but that's not a slam dunk. When investors look at a data center, some actually see a gateway to the second, industrial revolution, but others see a warehouse full of perishable chips. And when you look at the large language model, some see it as, a key to artificial general intelligence, but others see a dead end. So there's bifurcated opinion and views on how AI is going to pan out. But what it does do is to embolden the companies to stop hoarding labor because the promise of productivity gains. And that really wrestled away the bargaining power from labor and workers. As a result of that, we can see, the first order impact will be from the margins from companies adopting AI through efficiency gains. And the productivity gain, on the other hand, will be a bit more arduous process because we need to create new jobs to employ those displaced workers. And over the long term, productivity really is everything. Without productivity, we will still be in an agrarian society and everybody will be expert farmers. We can debate whether AI is in the bubble or not, but for an investor, the more new jobs you can come up with, the more bullish you should be on the AI trade.
All right, let's talk about your second theme. Of course, Fed Chair Jerome Powell's term and next year. There's concerns about Fed independence. And again, that is your second theme. Why don't you walk us through that?
Well, the Fed monetary policy is very important. It sets the risk-free rate around the globe and impact the stock price everywhere. As a result of that, Fed independence is very important. When we talk about Fed independence, what we really mean is whether the Fed will be able to go against political pressure to raise rates when inflation creeps up. Because if there's a Fed policy mistake, then inflation becomes unanchored, then that will entail very aggressive Fed rate hikes down the road and impair risk asset prices down the road. We had a glimpse of that in 2022. So with the new incoming Fed chair, it's not clear whether we're going to have a William Martin under Truman or Arthur Burns under Nixon. Both Fed chairs were appointed to diminish Fed independence, but the outcome was very different. One safeguarded Fed independence, the other unleashed runaway inflation. So apart from Fed independence, another theme is very interesting, is the way that the Fed implements its monetary policy. It's likely that the Fed will revert back to the corridor system advocated by the Treasury Secretary Bessent. What it means is that the Fed will drastically shrink its balance sheet. That will have to be, very well thought out, implemented to avoid market volatility. Right now, the Fed actually has the liquidity tools to help us navigate that. What it does ultimately is to reduce the perceived and actual debt monetization risk by expanding the Fed balance sheet. So in all, that could be a good thing for Fed independence.
All right, and finally, you say that investors need to be aware of what's happening with cyclicals. What are you seeing in that sector right now?
So in 2026, we expect the market leadership to broaden out from technology to cyclicals. As I mentioned before, we're seeing a cyclical kind of stars being aligned with the reacceleration of U.S. economic growth, positive fiscal and monetary impulses, and diminished policy uncertainty going to 2026. So with that, we see positive price return potential from quality cyclicals. That would include banks, aerospace and defense, and luxury. So maybe unpack that a little bit, starting from banks. For banks, we're expecting higher shareholder return based on less onerous capital ratios and banking regulations. And we also expect a very robust capital markets and advisory activity in 2026. On top of that, we're not seeing a credit cycle, so the loss from credit and credit charge-offs will be fairly benign. Moving on to aerospace and defense. For aerospace, it's really a free cash flow story because it's an operational turnaround with higher production rates and higher pricing power. And on defense, you have the added bonus of bipartisan support for defense spending. In 2026 and 2027, defense spending could reach to about $1 trillion in both per year. So that's very positive for defense companies. And third, we're moving on to luxury. It's really a case of earnings recovery after a few tough years. That's off of back of very strong and enduring brand equity and product innovation, as well as pricing optimization. So if we can see some volume pick up on the back of easy comps and a bit of improvement in consumer sentiment, we can see a good return from luxury stocks.
So
go ahead. Maybe there's an added importance to diversifying to the cyclical trade because the market right now is extremely concentrated in the S&P 500 index because the tech and AI beneficiaries. And it's very important to diversify and build a more resilient portfolio, tapping into unrelated investment themes so that you have different things working for you at different times.
All right, let me to the next question. Given that backdrop, how should investors be positioning their portfolios in this type of environment?
So for equities, we're expecting low to mid-teens return for 2026. That will outpace bonds. And for bonds, we're expecting returns of 4 to 5% in stable income, and that beats GIC. And we also expect bonds to be able to diversify against stock holdings in a growth-led slowdown if inflation remain well behaved. So all in all, we expect a very constructive backdrop for risk assets. What I want to talk about more is when investors typically ask about, should I invest in stock markets? Probably that's the wrong questions to ask, because if you want to grow your wealth and stay ahead of inflation, the default is to stay invested. And investors should spend more time thinking about how diversified they want to be. Generally speaking, if you are more conservative and the outlook is less certain, then you will be more diversified in your portfolio. There are 3 ways to increase your diversification. First way is to through diversify across time by having a longer investment horizon so that you don't have to crystallize your loss in any given down year and risk permanently impairing your capital growth potential. And the second way to diversify is to get off the cash stock teeter-totter, because there are better yielding instruments that offer higher income, higher but stable income than cash. What we talked about is bonds and mortgages. And they also have the added benefit of going up in price, especially for government bonds, when the growth slows down, especially when inflation is tame. And the third way to diversify is really selecting stocks that are indexed to different investment themes. Right now, the market is concentrated in the AI theme, so it's important to dial into the cyclical theme, for example, to diversify and make sure the portfolio stay resilient.